What we want to talk about today, not surprising, is the impact of this thing that we've been living with for the past few weeks and called COVID-19, also known as coronavirus. And what we really want to talk about today is the implications and the impact of this pandemic on the insurance industry as a whole. And what we wanted to do today, and we'll try to keep it very concise and clear, but what we tried to do today is touch on both the risk side of things as well as the distribution and sales side of things. We want to look at the whole industry, so life and annuity as well as property casualty. And with that, we have three distinguished guests today, very near and dear to the firm and to myself. First is Mr. Ron Schertz, who is the co-founder of Annexus, and he'll tell you a little bit about himself. We have Bill Jewett, was many years with Endurance, and a lot of you probably know him, and now the founder of Obsidian, which is a fronting platform, and he's going to tell you a little bit about that. And Chris McKechnie, CFO of Relation, many years at Swiss Re and otherwise, and currently running all the finance and a lot more for Relation, which is a brokerage and MGA all across the country. So let's start with you, Ron. If you can just say a few words about Annexus, about yourself, and just you know, how this pandemic is treating you so far, even though you're in Arizona and playing golf.
Yeah, the rules have been a little bit different down here, although we've been staying home. So just a real quick 30 seconds. Annexus is a product development company in the life insurance and annuity space on the insurance side. So we actually invent the widget. Our ultimate customer is the independent advisor. So the stockbroker, the financial planner, the insurance, the RIA guy is actually out seeing clients. And we're kind of behind the scenes, and we've got relationships with Nationwide, AIG, Transamerica, Athene. These are relationships that we have. So we actually build the products behind the scenes. And ultimately, when the advisor actually sells that product to a client, they hypothetically would get a Nationwide policy as an example, but underneath the coverage, it's actually Annexus who's actually created the product structure, the design, the hedging strategy. And then, so how's it changed our business? First of all, obviously we know that nobody was ready for this. You know, unfortunately in our business, from an advisor facing perspective, when I go down the line who actually probably is affected more than us, which ultimately affects us, is this is still a high touch people business. I mean, when you start talking about moving a client portfolio of $1 million or $10 million, it's just not something you're going to do over Zoom. However, there's a lot of that activity going on. If advisors have an active book of business, active client base, I know they're having lots of conversations on FaceTime and Zoom. I do think going forward, obviously, is this thing continues to take hold and probably sets for the rest of our life, that activity with that client probably becomes a little bit more generated through technology. So I still don't think we're ever going to get away from the high touch, because typically how those client relationships start is, you know, they're meeting the client out for dinner, they're having the client in their office, they may be going to the client's home to establish some kind of a new relationship. So that just doesn't exist today. If that changes in the future, we can go back to that a little bit. But I do think that things like annual reviews or consistent reviews with the client probably becomes more efficient for the advisor. The fact that he can use technology, use a Zoom approach to see the client, walk through existing transactions, portfolios, et cetera. But at the end of the day, we're still in this people business. So obviously we've been affected pretty dramatically because of that. So technology, no question, is making a difference as far as going forward. But again, at the end of the day, pretty hard to establish a relationship without having some kind of face-to-face time with the client.
Thank you, Ron. And we'll talk a little bit more about it in a minute. Bill, do you want to talk a little bit about Obsidian?
Yeah, sure. Obsidian is positioned as a new generation, we call it fronting company, capitalized with $85 million of capital in the insurance company, subsequent to a $100 million raise. Genstar Cap, a private equity firm in San Francisco, is the, other than management, the sole investor. was a $100 million raise. Our strategy is to be a fronting company, but I think that's the key differentiator among probably a number of things, but the key differentiators are underlying focus on only writing business we expect to be profitable, not looking at us as a credit pass-through. So really being designed as an underwriting company, which obviously is consistent with our line of sight on taking a net retention on a significant number of the transactions. Strategy being to develop business and opportunities from MGAs, MGUs, and other risk aggregators, and pass through 95 to 90% of that risk on a proportional basis to the reinsurance community. Some of it being driven by the relative growth and relative profitability of the MGA, MGU space. Some of it being driven by the dynamics in the risk aggregation space, and also some of it being kind of a pull factor from the reinsurance community who wants to see that risk, but due to channel conflict and other issues, aren't going to see that risk from the larger companies who retain at least the profitable risk net and will not see it out on a proportional basis. As far as the impact of COVID-19 on us, on one level, to have a clean balance sheet, A-7 balance sheet, unencumbered by legacy business, and not being distracted by other stakeholder concerns regarding the virus, whether it be BBI, not being quote unquote distracted by having to manage a number of employees during this obviously terrible situation. Ourselves working out of our homes as we founded the company over the past few years, being very used to communicate that way without physical office space, not having to deal with a lot of incoming questions from rating agencies and insurance departments, et cetera, with respect to the book we have, the policies we have in force, because we have none at this point. So from that standpoint, fundamentally having a clean piece of paper going forward in almost any dislocated environment, we find as advantageous.
Thank you, Bill. And to one of your potential clients, Mr. McKechnie.
Perfect. Thanks, Arik, and thanks for hosting this. Relation is a top 40 broker in the United States. We've got roughly 115 million of revenues, 500 plus employees, and we operate nationally, but we have about 35 offices in 11 states. We provide a variety of solutions in the property casualty space, employee benefits, education solutions, as well as wealth management. Aquiline Capital Partners acquired the business roughly a year ago, and we've been employing a strategy that's focused on solid organic growth and using the accelerant of M&A to really push that business forward. We've got the infrastructure to do that. We completed 7 transactions last year, and kind of pre this pandemic had anticipated that to grow significantly in 2020. However, I think with all of us, we took our 2020 plans, the original ones, which you probably developed in the fall of last year, and did a full reset. We looked bottom up at the new business. We look at our rates. We look at our exposures. We looked at the expenses in the business, all with a mindset of uncertainty that this current pandemic is bringing about. And we've run numerous sensitivities around it. To kind of Bill's comment, we are very fortunate to have a terrific partner in Aquiline, very knowledgeable about the space, standing behind us today to support us. But we are operating out of an abundance of caution. We do think that there's going to be an impact on all of us. It's an absolute slower economic growth, but we want to turn kind of this period of uncertainty into an offensive opportunity for a relatively early stage portfolio company of Aquilines. We think we've got the infrastructure to do so.
And Chris, maybe follow up to you from a new business perspective. Obviously, it's going to be hard to get new clients, et cetera. What about the loss of accounts? So, you have companies running out of cash, going out of business. Retention is usually very high with companies like yourselves. And now it seems like it could be a major hit. How do you view that as an impact to revenue and to EBITDA?
Yeah, so relations retentions historically have been very high, above industry normal, and I think a lot of that has to do with the servicing of our accounts as well as our client base. I expect that over the next 6 months, the industry overall is going to see retentions incredibly high. That said, our sales leaders have continued to say to me, if we're not kind of out spending time with our clients or speaking to our clients regularly now, the retentions impact is actually going to be seen a year from now or post to kind of the get back into work phase of this. So we have to service our clients now. We have to kind of spend time with them, or you should know that others are actually making calls into them. So I expect retentions are going to be very strong in the near term. And depending upon the level of service you're providing, will kind of be an indication for the longer term. With respect to the impact on the rates and the exposures, I think this situation has proven out how important data is, and the ability to look at kind of book of business, look at your clients, understand what industries they're in, because not everybody is going to be impacted in the same way. While I think we're all going to be impacted, I think I feel very good about some of the industries that we're focused on. And we went and we did a deep dive into each of our client segments to understand what that impact could be in terms of payrolls coming down, if people are being furloughed, or if they need to reduce potential benefits. I think it will impact us, but I feel like we're pretty well insulated with some of the industries that we've focused on historically.
Thank you. Ron, I have a question for you on the annuity side. I see Athene trading, at very low multiples of book value. American Equity Life, F&G. Obviously, a lot of it is because of the investment side of the business. Their book is suffering. But from a sales perspective, and not a lot of people have their ear to the ground like you, are sales dramatically lower? Do you think that this could come back in any way, shape, or form to what it was pre-pandemic? Where are we heading with this?
Yeah, so as far as them trading lower, I think a lot of it's just a sector related issue anyway. I don't think it's necessarily a profit issue at this point in time, because the actual ramifications of what's happened in the last 60 days has not shown up yet on anybody's balance sheet per se. So I think it's more of a sector play. At the same time, the flows of business are down at least 50%, if not 75%, back to my point earlier that, you've got advisors that have had relationships in the pipeline, that they've finished the transactions. So the first 30 days, we didn't have that much of a drop in business, but the last 30 days we have, because now the advisor again can't go out and see the client. So that's absolutely, and how the Wall Street's figured out, obviously that what's this thing going to look like in 90 days to 120 days, and it's already priced in there, taking into consideration that the hits are coming on the balance sheet at some point in time. So yeah, it'll get back to where it was at some point in time, whether that's 12 months, 18 months. I don't know what that looks like. Again, we have to figure out a different way to touch clients and see clients, and the advisor to see clients. It's not just going to be the same as it was before this. We're going to have to see the clients a little bit different, but at the same time, we're still kind of in the warm and fuzzy business. I mean, the advisor sees Mr. and Mrs. Jones, and again, you start moving around a $1 million or $10 million portfolio. They're not doing it over Zoom. So there's this balance that has to happen. I think, again, as I said earlier, I think servicing the client, touching your clients differently, probably more efficient, more consistent, will come out of this. But yeah, we'll get back to where it was for sure. It's just going to be just a little bit different how we do it. And our services are needed. But again, we start looking at doing a financial plan with a client. It's a pretty extensive process that takes place. So anyway, that's kind of where my thoughts are.
And from a life insurance perspective, I speak with agencies and with agents, and it seems like it's more top of mind, right? I mean, obviously with death around us, unfortunately, people are thinking about, I need to protect my family if God forbid something happens to me. Do you see that in sales?
Yeah. So a couple things are happening. First of all, if it's just a simple transaction, I need to have a $500,000, $1 million term policy. That's a transaction that can happen, in this format, right? If it's a real advanced estate planning process that takes a pretty extensive financial analysis and where it fits into the client's estate, that's much more extensive. So back to my previous point. So yeah, the other thing that people don't know unless they're in our business, simple things like having to get a physical to actually, typically what happens is they would send somebody out to your office and actually do all of the blood and all the things they have to do. In some states, they've stopped that completely. It's not even allowed. So that transaction can't even take place. Now, grant you, we'll go through and we'll pull all their medical records, but any new stuff, they've got to go to the doctor. They've got to get that in the last, 30 days. In some states, they've stopped that. They call it parameds. They've stopped it completely. So there's still obstacles. There's no question that's top of mind. And my guess is when we come out of this a little bit anyway, I don't think that top of mind will go away. I mean, I think that thought process is still going to go on. Boy, what if I had to go through this again? So I need to be thinking more ahead, in the future. But right now, even the transactions are a little bit difficult.
That's great. Thank you. So, Bill, you have a clean slate, no legacy. You can pretty much take this company to any direction. What, in light of what's happening, have you adjusted your plans? Or do you look at different venues to get new business and to get this thing starting? Where is the vision? How's the vision changing, or has it changed at all?
I would say the ultimate vision hasn't changed, which is to be a preferred provider of issuing capabilities to MGAs, MGUs, and risk aggregators, especially within the context of expense, crush throughout the continuum, which everyone's talked about for a number of years. And I think the virus or the situation we're going through may accelerate that as we overall become more efficient in a number of ways. And we've also laid the groundwork during our formative process over the past 18 months or so, and talking with many people within the industry that could be potential clients, MGAs, MGUs, large wholesalers, large aggregators. And that served us very well as far as developing opportunities which we're currently working on. Without that lead time, then, it would be very difficult to do that now. But even with that said, I think in this environment, having established relationships, in some cases over many decades, many years, not only myself, but my partners, in being able to leverage those in a situation like this, as our colleagues on the visual were saying, it's very tough to go to meet with people now, obviously, which is the preferred method, but to be able to leverage those long-standing relationships, much easier to do and to take advantage of those in a positive way than, say, start a new relationship with someone you've never met and have to do it over a Zoom call. We've actually positioned ourselves very well there. With that said, having that clean piece of paper, not being encumbered in many ways, in some ways even by people, we move forward. It allows us, again, in this environment, to be nimble, agile, to use the word opportunistic, which was used before, again, in a positive way, to provide solutions, or be at least part of providing a solution as people look at capacity crunches or bringing new capital in the industry, or if there's dysfunction with current carriers because of capital depletion or capital reallocation. So they're looking at the MGA space, MGU, even aggregation space differently. Having that clean capital, in many cases having relationships in place, we think we're well positioned. But our core mission of providing capital to as being a conduit in some ways to the MGA world, dependent on, as obviously, the reinsurance industry, which we know very well and know most of the leadership and the underwriters in that space through the previous experiences, that's going to serve us well also. I will say, one question we think about a lot is the challenges associated with as the industry changes. There will be dramatic change, and depending on what one reads and how one analyzes it, a significant event in the industry. Not like I don't think 2002, the industry lost 25% of its capital after investment income, 25% net, but certainly it'll certainly impact behavior, certainly impact maybe reinsurers' view of risk, how much they want to take on any one risk, diversification in their portfolio. So there may be challenges inherent in us placing the reinsurers, but we're well positioned also since we're only focused on business, which we think will be profitable and have a clear line of sight on that reinsurers will find attractive, we believe, even when they have to make capital allocation decisions or manicure their book. So we don't think that necessarily is problematic, at least as we see the world evolving. With that said, what the new normal will look like, we're just looking at it. We don't know. I mean, we can all prophesize about that. We just want to be nimble, agile, and active as well as reactive in many ways because we can be, because we have to be, and we're kind of built like that, almost by design, but also just where we are in the stage of our development.
And a follow-up question, I guess, to all of you. We talked a little bit about technology. Bill, you start a company. You basically can decide. You don't have any legacy systems and all that stuff. And I'm not talking about Zoom, and I'm not talking about any other video conferencing, but really kind of the day-to-day work, whether it's in the life and annuity side, where is there a possibility to have quote to bind fixed indexed annuity in the future? Is this accelerating it in your world, Bill? Is there a way to connect more efficiently with the MGAs, MGUs, and the reinsurance parties on the other side? And obviously, Chris, for you, what systems do you use, whether it's underwriting, policy admin, et cetera? Bill, maybe we start with you.
Yeah, I mean, we really think it's a huge advantage. I'm not a technologist, but just to, again, have a greenfield as far as being able to set up our technology and interactive with MGAs and reinsurers, on common platforms. And really, as I think most people on the call are aware, the industry is legendary for having archaic systems. And, some of our competitors or some people in the space, and this is in no way, deriding them, dealing in the program carriers, we want to focus on that, systems from the 90s, the turn of the century, even the turn of the decade. And it's tough to move those. It's tough to transition those. So that's in no way, belittling that or saying it's an easy fix there, because you're really moving mountains in some cases and dealing with those legacy issues. But being able to do it on a clean piece of paper, certainly I think we can be, we do it quicker, being more responsive, being more interactive and comprehensive, and perhaps most importantly, as we look at the crush of expenses throughout the continuum, doing it much less expensively, because we don't have to deal with those legacy expenses and legacy issues and things related to that. In many cases, you're still paying for the past.
All right. Chris?
Yeah, I think first and foremost, I'd say I do not anticipate that technology will disintermediate our model. I think our solutions are kind of the service we're providing. It is more of a face-to-face or kind of a sold product to kind of that our clients want to have a discussion with a knowledgeable counterpart. So I don't anticipate it will disintermediate. That said, I think that there's huge efficiency gains that we can recognize out of this. And as I mentioned at the outset, data is critical to be able to go and assess where your portfolio is, where your clients are, and how do you help them? How do you best respond to this? And with every day, something is changing. So it's being able to assess that as best possible real time. We've been building a data warehouse to give us greater flexibility internally, taking our various systems from a financial, from an operational, from a sales perspective, to look at all of that information and adjust on a real-time basis. And I think that will prove to be more important prospectively. for us. So I expect that we will see greater efficiencies coming out of this. I think improved automation. And I think I would echo what Bill said. I mean, in the past, the insurance industry has been very, very, very slow to adapt from a technological standpoint. And I think should be people should take advantage of this.
Thank you. And Ron, do you think there is an acceleration, there will be an acceleration of more direct-to-consumer, whether it's annuity, life, retirement income products, or do you think this is not going to happen?
Well, you know, I actually agree with Chris a lot. But I'm old school, right? So I'm still high touch, and it's kind of similar to when now you're able to see the doctor FaceTime, and he's able to prescribe something by seeing you, right? But at the same time, yeah, you've got a real serious issue, a knee injury or a heart issue. That's not something we're FaceTiming over. And I think in our business, you know, if you need a quote, if I can get you a transaction, we can FaceTime, and it's pretty simple. When you start getting into actual financial planning, start getting into estate planning, you know, you start getting into heart surgeries, heart analysis, you start getting into some of those things, you got to go see the doc. He's going to have to grab your knee. He's going to have to see you. And so I think there are some efficiencies that will be gained along the way. Maybe your follow-up, that when you would see the doc, you don't have to go see the doc, and now you can FaceTime or you can Zoom. That's a little bit different, but at the same time, it's kind of that same level, right? The common cold, you have to go in there and sit back in the day and sit in there for an hour, right? Now you can get the doc on the video, and you can do an analysis, ask you some questions, prescribe it, and be over with. So I think it's a similar concept, but there'll definitely be some efficiencies that will happen. But at the end of the day, again, this is a people business, and when you start getting into some pretty complicated transactions, it's going to require some face-to-face time and some face-to-face time with your professionals that you work with.
Thank you. So let's talk a little bit about the asset side of the business, and I'll start with you, Bill. How does you know, obviously rates went down, not the premiums, but rates, interest rates, and the market have been suffering, although kind of rebounded quite a bit in the past few days. But how do you view you know, the new or asset allocation in this new environment?
Yeah, in many ways it hasn't changed. You know, since we started investing, you know, rough and ready about 4.5 weeks ago, a very conservative approach, all high grade securities, no equities, have a very highly regarded outside asset manager. Within that context, he has seen some opportunities over the past 5 weeks. I think right now, I think we're rough and ready around 50% invested. So we've been doing it incrementally, but those opportunities have been fleeting. And, you know, our business model, you know, unlike some insurance companies, our business model is a bit different, since we're really not a kind of an asset accumulator on the balance, you know, from the asset side, because we're taking in a significant amount of premium, keeping a very small amount net in the intended reserves, and then ceding off the premium to reinsurers, say 95% of it. So, you know, we're not going to get a lift from that side anyway. That's not going to drive our results ultimately. Obviously, it'll give us some lift, but it's not going to be the driver of our success. And just our, you know, being a startup, relatively conservative vanilla portfolio. There's some opportunities, there's some challenges, but nothing that we think is going to impact us, you know, significantly over the short or long term.
And do you think, I mean, I'm actually using your past here a little bit, so forgive me, but if you were back, you know, with a carrier, would that view change? I mean, would you make some rebalancing? Would you adjust some of the allocations? Would you take advantage of some dislocations in the market?
You know, I think one would, you know, in a very prudent fashion, you know, when it made sense, and, you know, because you are more dependent on the lift that the asset side gives you, since you maybe geared, you know, 4 to 5 to 1, you know, assets to capital, and, you know, things of that nature, just from the standpoint of, you know, having those reserves on your balance sheet. You probably have some allocated portion in equity, so you may want to take a look at that or manage that discreetly in and of itself. You may be using 3 or 4 different asset managers, so you do want to kind of coordinated approach. or you just may use it as a way to strategically, if you see opportunities strategically, either on the debt side or on the equity side, make some moves to take advantage of this position. I would say not in a significant, but just to give some incremental lift. But certainly having a larger, more leveraged balance sheet with significant reserves, with a different duration, having already been exposed or invested in different, more diversified asset classes than we would be. Certainly you'd be taking a different focus on it and maybe being more opportunistic and look at ways that you can optimize it. We're just starting, so at this point, much more conservative. And again, it's not going to be a driver. Companies like established companies, it may be more of a driver. And there may be better ways to effectively manage your assets going forward from the standpoint of taking advantage of opportunistic situations or investing in funds which maybe have a reputation of doing that very well, obviously within the context of a very diversified portfolio.
Sure. And Chris, you've done it in the past and managed many billions of dollars for Swiss Re. What's your take on this?
Yeah, I think if you go back to the 2001, that might have been an inflection point where you started to see much greater adherence to a asset liability management framework, and kind of the amount of additional risk you were going to take was reduced. Now you've seen some hedge fund reinsurers that have maybe been outliers there. But for the most part, I think you've operated in greater confines due to regulatory requirements and more broadly. I'm not sure that there's a whole lot of upside to be gained from trying to take additional risk on the asset side. I think that what people are looking for, particularly on the reinsurance side, is making sure that we've got a well capitalized, strong, long-term partner, and I think that's mission critical.
Absolutely, thank you for that. So with that, what I want to do now is I want to open it up for some questions from our audience, and I'll ask Sam to if anyone wants to ask a question, there's a Q&A tab that you can press. And we'll just ask the questions for you. Sam, if you can do that, that would be great.
Yeah, thanks, Arik. We've gotten a couple questions in, and like Arik said, just press the Q&A button at the bottom of your screen and type in a question. We'll be able to see it. Maybe let me just start with a question that we've got. I think each member of the panel can address this, but do you see any new insurance products emerging after this crisis, and where do you see potentially change in demand for insurance products as a result of the crisis? Maybe we'll start with you, Ron.
Yeah, so I mean, it's happening as we speak. I mean, the interest rates at an all-time low, so you figure out a way to be able to hedge our structures a little bit different, and change the risk profile for the insurance company in this kind of environment. Some it's stuff we started working on a while back as interest rates started to slide down, and now that they're all-time lows, no question, we'll have some more efficiencies in our products. Make it a little bit easier for the insurance company to be able to hedge and be in a situation to be more efficient, in the future. So that's absolutely what that exactly looks like. Is a pretty complicated model, obviously, with the actuaries and the investment banks and trying to put everything together. But the whole complexion of how our product structures work and how clients buy those is completely changing.
Right. And Bill, do you think? I mean, obviously, pandemic is a big word nowadays for a good reason. Do you think there are going to be programs built around pandemic, stuff that you're going to see as you try to support MGAs, MGUs?
I think, on one level, I would say yes. I think you'll see some people being innovative, trying to develop some innovative products, but at the same time, I would see, and Steve Catlin has probably came out with this initially a few weeks ago, and others have gotten on board in different ways, the development of an industry solution No one quite knows what it's going to look like. You know, the dollar is obviously huge and beyond the scope of the industry as it stands today. You know, given, you know, what potential loss could be in various situations. But, you know, that would also potentially lead to involvement by the capital markets as a contributing source of that risk capital, if they could get their hands around it in some degree. But certainly there'll be a lot of effort, I think, in the intermediate term, maybe not dissimilar in some ways to the wars, you know, subsequent to 9/11 vis-a-vis the terrorism in Tria. So certainly there'll be a lot of activity and a lot of energy spent towards that. I don't think anyone at this point really knows what that will look like and what the products will look like, especially on a large scale industry solution level. But I would not be surprised if ends up being a joint effort by, again, you know, it's very tough to decide, you know, based on probability and price and expected loss. It's very tough to get a hands around that, and that's what drives insurance. I would not be surprised if it's an industry solution, or if it's an industry solution which does encompass additional capital or contingent capital from different sources, such as the capital markets, which may be big enough to develop what would be a usual solution or a widespread solution.
Right. Chris, do you see any new products?
Yeah, I think you've got some governments and various states that are looking at different options that are coming out to how do you address pandemics. I think pandemics had always been a on the radar screen back to my days at Swiss Re. I think what we've found is we've been largely unprepared for pandemics, and that's on a variety of fronts. And so I do think that there's discussion about how do you kind of provide greater coverage, or are there different means to do it? At the present time, I think you've got a lot of politicking going on in terms of kind of, you've got legislators that are putting out positions that I think are in some cases incredibly extreme. I don't think those are rational. I think that the industry overall, both carriers as well as brokers, need to better coordinate to address how do you answer some of the questions that politicians are pushing forward. Because it's got long-term implications for the industry overall. So
right.
I do think you will see some kind of additional coverage. You might find clients that all of a sudden realize that they either have something new that they want to cover. There will be kind of add-ons. We're seeing a lot of opportunities today. We talked about how hard it is to sell new business, but cross-selling to an existing client is kind of one where you've already have an established basis of trust. So that's something that we are definitely focused on. And the other is just reaching out to people that you'd have spoken with historically that you might want to just check in on. I think right now, with everybody sitting at home, I know we're all doing a lot of Zoom conferences, but people want to talk. People, your clients want to better understand what's happening.
For sure. Thank you. Sam, next question.
We've been getting a lot of questions, as you can imagine, about business interruption policies. Maybe if you could share your views on potential litigation that might arise from policyholders feeling like they had coverage, but also what is this dynamic of insurers potentially denying business interruption claims? What does that do to the relationships between clients, the brokers, and the carriers, and what needs to be done to kind of help keep that communication running smoothly?
Chris, maybe you're the best to answer this.
Well, I think there's as I said before, there's a lot of back and forth. We've carriers are trying to address this in terms of what is in a policy, what is not in a policy, and I think it's very difficult for people to look back and say retroactively, we want this covered, and I think that's where. If a policy didn't have a clearly defined kind of definition around kind of a business interruption such as this, then I think that there's there shouldn't be as much debate as there will be. And I think that there's a lot of people that will make money off of this situation, but ultimately, I'm not sure that many of these policies have kind of true coverage in a retroactive way on a business interruption basis.
All right. Sam, any more questions?
Yeah. One, we've seen a lot of states issue guidance relaxing the grace period for policyholders to pay their premiums. How's this impacting on brokers' finances? Is it causing balance sheet strain? And are there any unusual steps that brokers are taking to maintain their balance sheet health?
Yeah, maybe Arik, I'll start here. But I think when this, we are always managing our cash flows and very, very actively. But I think what we did when we started to see the COVID-19 situation develop, we ran a number of sensitivities as the what ifs. And I think one of those is around a slowdown of payments. I think we are anticipating whether it's a 30, 60, 90-day deferral, which will result in cash flow slowing down. And so I think we've been planning accordingly, making sure that we've got kind of our expenses in check, that we understand kind of the movements. And that coupled with, as I said earlier, the support of our capital partners and our lenders is, I think, positioned us well to take the current situation and try to move it to being more offensive for us.
Thank you, Chris. Bill, anything to add on that?
No, I don't think so. I think Chris kind of hit it on the head. I mean, there's certainly a lag and a catch up, and then we'll see if the GDP can pick up, if this can be an acceleration of quote unquote payback and get things back to normal. But no, I think nothing really to add. Okay.
I guess one thing, Arik, I would say in terms of the carrier partners that we have, I think carrier partners have been helpful to brokers. I think some of the efforts that they've made in terms of kind of recognizing the cash flow situations, there's the relationship, I think, is only getting stronger.
Right. Thank you. Okay, so I think we're just on time. I wanna say a few words. Just I'm an optimist, and I think that science is going to prevail eventually, and hopefully we're going to go back to the normal that, or close to the normal that we've been through, which could be reflected, if you believe, in the markets today and in the past few days. And that's our wish for ourselves, for our families, for the world. But obviously, I think that these past few weeks have shown that we can adjust and we can adapt. And the fact that we're doing a webinar for 150 people today is just it's to show that we've adjusted. And I think here at Houlihan Lokey, we're doing the best that we can to stay in front of our clients, to stay in front of the industry. And I can't thank you enough, Ron, Bill, Chris, for hopping on today. It means a lot to me and to our group. We wish you only health and great success. Whether you're starting the business, Bill, good luck and congrats.
Thank you.
Or Chris, Ron, obviously keep making strides and being an industry leader. We really appreciate the time, and we hope to see you again very, very soon, and perhaps even in person. So the better.
Well, thank you to Houlihan Lokey for hosting this. I think if we can kind of be of any further assistance to anybody on the phone, I think we feel well positioned to assist clients, whether it's EB clients, whether it's PNC clients, or just to figure out what's going to be the new normal. I'm glad to have follow-on discussions.
Thank you.
Thanks, Arik.
Yeah, same here. Yep.
Thank
Thank you.
Thank you.